Welcome back, guys. Let's discuss how to calculate cost of capital. What is capital? Let's say a business needs $100,000 of investment. This is the required capital for the business. Now, how this business will get this amount? There are two sources which we call sources of finance. One is equity and the other is through debts. Equity means amount coming from the owners of the business, and these owners will have to bear the risk of loss, whereas debts is the investment through those who do not own the company, and usually they will be investing against a fixed return. So whatever is paid to equity holders is called cost of equity. So whatever the company pays back to its equity investors will be called as cost of equity, and we usually denote it by KE. And whatever return is paid to those who have invested through debts is called cost of debt, denoted by KD. So let's say in this case the company decides to have 70% of its capital coming through equity, and since they bear more risk, therefore they will be getting more return, and let's assume it's 12%. The cost of equity is 12%. And let's say 30% of the total capital of $100,000 is financed through debts, and because of less risk, let's say they are paid an overall return of 7%, we call cost of debt. So 70% of 100,000 means $70,000, and 12% of 70,000, if we are paying 12% to those from whom we have got $70,000, then it means we will be paying them $8,400 in total. Whereas 30% of 100,000 would mean $30,000, and 7% of this will be equal to $2,100. So after 1 year, $8,400 will be paid to equity holders and $2,100 will be paid to debt holders. A total will be the sum of these two. So in total the company will be paying $10,500, and that is against the $100,000 of investment. So if company wants to find out how much in percentage terms it is paying against the whole capital, so it is going to be 10.5%, and this includes both the return paid to equity holders and the return paid to the debt holders. Therefore it is called weighted average cost of capital, WACC. So against the whole investment of $100,000, the company is paying 10.5%. The reason why we have calculated is that the company should be aware that this capital will require a minimum return of 10.5%. So it has to ensure that whatever project it undertakes that should at least yield a return of 10.5% to satisfy every type of investor. That's why we use this rate for appraising projects and calculate net present value to ensure that we are earning at least 10.5%. So this is one way of calculating this WACC, and the other way of calculating this weighted average cost of capital is to just pick cost of equity, which is 12%, and multiply it with the proportion of equity, that is 70%, plus pick the 7%, the cost of debt, and multiply it with the proportion of the debt. So take 12%, 70% of the 12, which will be 8.4%. Then take 30% of the 7, which will be 2.1%. And if we add both, it's gonna be 10.5%. That's your WACC, same one which we calculated here. So this is how we calculate weighted average cost of capital. Now the problem is how to calculate this cost of equity and how to calculate cost of debt. So in the next video we will be learning how we calculate cost of equity, and then we will learn how to calculate cost of debt.